the EURUSD hack banks don't want you to see. Alright, let's be real. Have you ever wondered how the major banks consistently pull in massive profits from the EURUSD market, while the average retail trader seems to be perpetually stuck in a cycle of losing? Have you ever placed a trade that felt perfect, meticulously analyzed, only to watch the price spike down, hit your stop loss by a single pip, and then immediately reverse to go exactly where you predicted it would? It's infuriating. It feels personal. It feels like the market is out to get you. You hear about the infamous 90-90-90 rule. 90% of traders lose 90% of their capital within the first 90 days. Why is this so common? Is everyone just bad at trading? The answer is no. The reason for this disparity isn't magic. It's certainly not luck. It's a fundamental misunderstanding of how the market truly operates. The key is the smart money strategy. And today, I'm breaking it all down for you. There will be no gatekeeping here. No confusing, overly complex jargon designed to make this sound like rocket science. Just the simple, hard facts about how the financial world's biggest players navigate the Forex market. By the end of this video, you won't just understand their strategy, you'll know how to use it to your advantage. So, what exactly is smart money? The term refers to the collective capital controlled by institutional traders. We're talking about the titans of finance, central banks, major commercial banks, hedge funds, and other large financial institutions. Their money is smart, not because they have a crystal ball, but because the sheer volume of their transactions is enough to actually move the market. Unlike a retail trader who is a price, these institutions are price. They don't just participate in the market, they create the waves that everyone else tries to surf. Think about it this way. If you or I want to buy a standard lot of EURUSD, we just click a button, and the order is filled instantly. But what if you needed to buy $10 billion worth of euros? You can't just hit buy. An order that large would instantly signal your intention to the entire market, causing the price to skyrocket before your order is even halfway filled. This is called slippage, and it's the enemy of large institutions. To avoid this, they can't just buy when they want to buy. They need to be more cunning. They need to find a place where there are enough sellers to absorb their massive buy order without drastically affecting the price. They need to find liquidity. This is the absolute core of the smart money concept. They don't guess from charts. They engineer moves to hunt for liquidity. So, where does this liquidity exist? It exists wherever a large number of orders are clustered. And where do retail traders, taught by the same old textbook methods, tend to place their orders? Exactly. They cluster them around obvious technical levels. We're talking about key support and resistance zones, prominent trend lines, previous daily, weekly, or monthly highs and lows. These areas are magnets for orders. Retail traders are taught to sell at resistance with a stop loss just above it or buy at support with a stop loss just below it. Every single one of those stop losses is a pending market order. A stop loss on a short position is a buy order, a buy stop. A stop loss on a long position is a sell order, a sell stop. For smart money, these clusters of stop losses are not safety nets, they are targets. They are giant flashing pools of liquidity. If a bank wants to sell a massive EURUSD position, they need to find a huge number of buyers. Where can they find them? At a price level where thousands of traders have placed their buy stop orders. So what do? They use a portion of their capital to artificially push the price into that zone of buy stops. Let's walk through a classic EURUSD example. Price has been respecting a clear resistance level. Retail traders see this and start placing sell orders, putting their stop losses just above the resistance as they've been taught. Smart money sees this buildup of buy stops. They want to initiate a large short position, but they need buyers. So they engineer a move. Price suddenly shoots up, breaking through the resistance level. This triggers two things. First, breakout traders jump in, buying the breakout. Second, and more importantly, all those stop losses from the short sellers are triggered, creating a flood of market buy orders. This sudden surge of buying is the liquidity the institution was waiting for. They can now fill their massive sell order at a great price, absorbed by all this retail buying pressure. Once their orders are filled, they remove their buying support and the price tumbles down hard, leaving all the breakout buyers trapped and all the short sellers stopped out. That sharp spike and aggressive reversal, that long wick on the candle, that's not random volatility. That's a footprint. That's smart money hunting stops. They trigger retail stop losses to fill their big orders, and then they ride the real move, leaving everyone else behind. Sounds unfair, right? But once you see it, you can't unsee it. So the million-dollar question is, how do we trade them? How do we catch these powerful moves without getting hunted ourselves? The secret is a complete paradigm shift. You must stop thinking like a retail trader. First, you don't jump in with the crowd on breakouts. A breakout of a key level should now be a warning sign for you, not an entry signal. Instead of chasing the move, you exercise patience and observation. You watch those key breakout areas, the support zones, the resistance zones, and you wait. You wait for the manipulation. If the price spikes aggressively through a key level, pauses for a moment, and then snaps back inside the range just as quickly, that is your number one clue. That's the signal that smart money just took the liquidity sitting on the other side of that level and the real move is about to begin in the opposite direction. This pattern is often called a liquidity sweep or a Judas swing, but we need more than just a clue. We need confirmation. This is where we can get more technical. After you see that liquidity sweep, you need to wait for the market to show its hand. We look for something called a change of character or a break of structure. Let's say the price was in an uptrend, making higher highs and higher lows. It then sweeps the liquidity above a key high. A true change of character would be when the price then breaks the most recent significant low that led to that high. This break tells you the market's intention has shifted from bullish to bearish. Once you have that confirmation, you don't just jump in. You wait for the price to pull back to an area of interest. This could be the order block, the last up candle before the down move that broke the structure. This is often where the institutions have leftover orders to fill. You set your entry there. So, the full process is, 1. Identify a clear pool of liquidity, like above an old high. 2. Wait patiently for the price to sweep that liquidity with a sharp, aggressive move. 3. Wait for confirmation, a break of market structure in the opposite direction. 4. Identify your entry point on the pullback, typically an order block or an imbalance left behind. And 5. Manage your risk. I keep my stop loss tight, placing it just beyond the high or low of the manipulation wick. If the price goes back there, my entire trade idea is invalid, and I want to be out with a small loss. The beauty of this is that because your entry is so precise and your stop is so tight, your potential reward can be massive compared to your risk. We're often looking at setups with 1 to 5, 1 to 10, or even higher risk-to-reward ratios. This way, I'm riding with the banks, not against them. I'm using their own tactics to find high-probability entries. Let's do a quick recap of this new mindset. This is your new trading plan. First, your primary job is to be a liquidity detective. Look at your EURUSD chart and mark the obvious highs and lows, the clear support and resistance levels. That's where the fuel for the next big move is located. Second, stop following the herd. Do not chase breakouts. See them as potential traps. Your edge is patience and observation. Third, watch for the signature of smart money, the liquidity grab. Those sharp spikes followed by aggressive reversals are your call to action. Fourth, always wait for confirmation. Don't enter on the spike, wait for the market structure to shift, for that change of character, to confirm the institutions have shown their hand. Finally, enter with precision on a pullback and define your risk. Place your stop where your idea is proven wrong and aim for targets that give you a significant reward. This isn't about winning every trade, it's about making sure your wins are substantially larger than your losses. By following these steps, you stop being the liquidity and start trading alongside those who hunt it.